Okay. Hello, my name is Andrew Everett, and I'm so pleased and honored to be joined by Alastair Thomson today, author of Cash Flow Surge,
That's the one.
101 no-cost and low-cost fast action strategies to boost your cash flow. I posted a review of the book on keypoint.org, which you can read, but I'm really excited to be able to speak directly with Alastair today. Hello, Alastair.
Hello, Andrew. Very nice to be here, and thank you for the opportunity to have a conversation.
With 5,300 miles of social distancing, I might add. You're in Yorkshire, England, and I'm in Santa Monica, California. And by the way, in that honor, I have my cup of Yorkshire Gold here.
Snap.
So maybe we could just start. Tell us a little bit about how this book came to be with your, the 30 years of financial experience that led up to that.
Yeah, sure. I've worked in the business world for some time. I am an accountant by background. Although I've done a range of other things in the business world at executive level, including some time as CEOs and CFO and chairs rather of different organizations. And I think I've always been at the more interested in how accounting and finance can help businesses be more successful, rather than kind of reveling in the detail of advanced tax policy or something like that. I'm not saying that's not important, and clearly there are some people that really take to that, but it's not really where I come from, because I think done in the right way, accounting and finance can actually be really helpful to help businesses grow. And that's the element that very few people think of when they think about how can accountant help my business. People often think, oh, well, I can pay less tax, or I can cut my costs, and yes, that's true as well. But I often think about it as, if something cost you, say, $10,000, that can only the minimum you can ever spend in that is zero. You can only ever save the 10,000 you're spending. Whereas if you can make 10,000 in sales into 100,000 or a million or 10 million sales, your upside is almost infinite. Whereas when you're just looking at it from the point of view of cutting costs, all you can ever save is that 10 grand, because that's all you spend on it now. So I take a kind of different view of what accounting and finance can do for business. And I think really what I was trying to do in the book was to translate some of that and some of the stories and experiences, because I think, again, part of the issue people have people who don't work in finance have this issue, but actually some people who work in finance also have this issue, is that, I kind of get the idea, but I don't know how to do it. I don't know, I don't have a template to follow. I don't have a structure that makes sense. And so even if I want to do it, I'm kind of stuck a little bit. So I thought, well, if I do it as a series of little stories and little experiences that I've had in the past and collate them together, it's not a theoretical thing. It's not a academic textbook, but it's something that if you're a business person, you can kind of sit down with it, and in 5 or 10 minutes, you can go through each individual idea and build that over time into something which hopefully makes a big difference to your business.
Right. It definitely read like this book was written for either small business owners or CEOs of medium-sized businesses. It's definitely not a wonky book for accountants.
I'll take that as the compliment I'm sure it was intended to be.
Well, so I guess the point is maybe so there's as you were getting at, accounting can be about taxes and balance sheets and so forth, but for investors and the things that you traditionally think of accountants focused on, but there's also the managerial side of accounting. And so how can you use accounting to help you make better decisions and inform your decisions about running the business? And so that's the part that kind of interested me, is you're coming at it from an accountant's point of view as to how to be a better manager.
Yeah, I think that's probably fair, and I like to think of it perhaps like a lens that you can put on to something, or a filter. So it's you can look at let's say a factory as a kind of operational bit of activity. Some materials are coming in and machines are working and something's going out the other end, and you could see that as an engineering process where something is being manufactured, or as I often do, I would look at that as a kind of financial end-to-end process. And it's not to say that the engineering of it's not important, because that's how you make the product. But I might look at that and I might go, well, actually, we could make this a more efficient, more effective operation. We could perhaps look at ways of reducing our unit cost, which is not about the engineering of it, but it might be about the organization of it. And the truth is, in a lot of these things, the financial bit is the bit you come to last, and it's only really the last kind of 5 or 10% of it. Because if it doesn't work operationally, then there's no point in trying to have some wonderfully designed and executed financial strategy, because it's pointless.
It's too late at that point.
Yeah, so I think the idea that a lot of people think, oh well, the accountant sits in a room somewhere and works out some spreadsheets and is going to tell us what we need to do. I would say if you work for an organization like that, run a mile, because sooner or later that's going to go badly wrong. You've got to work with your workforce. You've got to get them as motivated as possible. You've got to get the quality of what you make as high as possible. You've got to make sure your customers are satisfied, make sure they're delighted even with the service that you provide. And then if you can do all that, then you can sit down with your financial slide rule and say, well, this is how we put it all together. This is how we make it work. And this is how the business is better as a result of doing whatever it is we're going to do.
There's a quote I love it's on page 1, actually. As the old saying goes, often there's too much month at the left at the end of the money. It really encapsulates what cash flow is. I mean, cash flow and profitability kind of overlap. A lot of the strategies that you talked about in the book would increase your profitability as well. But a company can survive periods of unprofitability, but it's very hard to last very long periods of insolvency.
Yeah, that's so true, and it is one of those things that very quickly sounds like it is a bit of accounting nerdy stuff. So I won't perhaps dive into it in too much detail, but there's generally accepted accounting principles, or Gaap, which is the way people put their accounts together. For a variety of reasons, some good, some less good. They don't necessarily reflect the actual cost you have of running the business, the money that's coming in and the money that you're paying out. And again, why I particularly focused on cash flow for this was exactly what you said earlier on. It's designed to be something that people who are running a business, who are perhaps not accountants themselves, and they may only have maybe a fairly junior accounting person inside the business, or they might even have an entirely outsourced operation to somebody else, is to try and give them some tools to manage the cash, because it's the cash that's going to get you a long time before the profitability does. If you look at even really successful businesses like Amazon, for example, Amazon ran gobbled like nobody's business for a very long time. I know now we look at Jeff Bezos and say, oh, he's the richest guy in the world, and by the way, wouldn't it be lovely if he paid some tax now and again? But for a long time, that organization gobbled up cash. The only reason Amazon survived when a lot of their peers didn't was they were, through good luck or good judgment, they raised a lot of money before the dot-com crash in the early 2000s. So they had plenty of it to see them through until the point when actually they became profitable and were generating cash themselves. Right. And that's an example of why cash and profits are not the same thing. Amazon had loads of cash and no profits back then. And now probably it's good. Well,
but most businesses don't have that luxury. Most, especially smaller businesses, they don't have a VC behind them or public markets behind them. Was there a specific target demographic that you were going after, say, businesses under 10 million or between 10 and 50 million or something in specific?
I don't think I would put a sort of a limit of that on it. I mean, it's not for large multinationals with 43 million accountants in a head office in London or New York or somewhere like that. It's not to say they wouldn't get something from the principles of it, but that's a slightly different game. What I'm much more interested in is actually how business people probably running their own business, although it might be quite a big business. It could easily be a £50 million business, but someone who's running their own business can actually make a difference to what they do and how they do it. And a lot of what I talk about are things that are maybe a bit counterintuitive, and they're maybe not the sort of things you'd expect to hear from an accountant. But in my own professional career.
Speaking of counterintuitive, that there was an example of that with high margins don't necessarily mean high profits. Maybe you could speak to that one.
Yeah, I think it is one of those things, because I think when you're used to dealing with numbers and you kind of think through what people are really trying to achieve, you maybe get a slightly different take on it. So a lot of people focus on the margin. I'll talk to a lot of business owners and they say things like, oh, we're making a 50% margin, whatever the number may be. And okay, that's lovely. A 50% margin, all things being equal, is better than, say, a 10% margin. So that's great. But what they nearly always mean with that is, I buy something for £10 or $10 and I sell it for £20 or $20. So in their minds, they're making a 50% margin. And that's usually what they mean when they talk about that. The problem is that what they tend not to think about so much are all the other costs of running the business. They just go, oh, well, if I'm doubling my money in everything I buy, of course I'm going to have a successful business. And whilst that can be true, it isn't necessarily true. So the example I mentioned in the book is actually about WeWork, which had, for all its other problems, has got actually relatively attractive margins expressed as a percentage. The problem is that all the fixed costs they have of the business, of paying their own rent or the buildings they own and the taxis and the staff and everything else, account for a lot more than the margin that they make on the goods they actually sell. Whereas somebody like a traditional supermarket, and I use a British supermarket, Tesco, in the book, but the same is true of Walmart or any supermarket around the world, actually they trade in very small margins usually. But they're making billions and billions and billions, because although they're making small margins, their costs are much lower than the amount of margin they generate. So a lot more cash drops through to the bottom line. And that's why, having a 50% margin is great. What you really need to say is, what's left over after paying all the other costs of the business? And it's not as clear cut as saying a 50% margin is better than a 10% margin, because that depends on what your other costs are.
So you have to factor not just the contribution margin, but also the fixed costs. There was another example that's related to this too, is like, how do you get those margins? In one of the chapters, you talked about sacrificing quality in order to increase your margins.
Yeah, and this is, again, it's one of those sort of slightly counterintuitive things, because usually what happens, and accountants are very good at this, because it's what we're taught to do as part of our professional training, is to look at the costs of things. And it is one of those things where I was sort of brought up at a time when things like total quality management and things like that were very much de rigueur. And there's a book which I know you like and I like as well, called Quality is Free,
yes,
by Philip Crosby. And I discovered that, I don't know, probably 30 years ago, something like that. But often the way to increase your margin is actually to make a better product and to serve your customer, because a lot of cost goes into putting things right that go wrong and to satisfying customers who are currently dissatisfied. And in a lot of businesses, if you could just stop doing those two things, you would actually find that your cash flow would improve. You'd find your business is easier to run, because you're not chasing around all the time because customers are calling you up going crazy on the phone. And actually you'd have the time to manage the business properly, because you don't have to break off whatever it is you were doing to fix a problem you created yourself a week earlier, 2 weeks earlier, a month earlier, when you kind of looked at something, you thought, oh, it'll be okay, the customer won't notice. But of course, a month later, they have noticed. And now they want you to give them a discount, or give them some money off, or do a special favor for them in the next order, or whatever the case may be. So a lot of these things are, if we can make sure that you're managing the quality, the old get it right first time mentality, you're trying to make sure you don't have rework, you don't have customer returns, you don't have customer complaints. If you can do all those things, actually you'll find your margins will go up and your costs won't change in the slightest. And that's the great thing about some of the things in the book, because it does, the whole idea was things that you can do that aren't going to cost you anything or aren't going to cost you very much, but will quite quickly pay back in terms of increased cash flow, and you're quite right, also increased bottom line nearly always as well.
It's a good segue into another question I had. There was a blog that you wrote called your blog is called Uncommon Sense from the World of Finance, and you had a post called Improve Customer Service Through Simplicity, where you said specifically, what do we do now that irritates the customers? Stop doing that.
Yeah, and that's an example of the same thing. I mean, you must have this. I have this a lot. I think probably everybody does, where you're dealing with an organization who have decided for you how you will interact with them, and they can't accommodate any different way of doing it, whether or not that's actually what their customers want in the first place. Virtually anything you sign up for online is guilty of this. And you know, even sort of quite large organizations who talk a lot about being customer centric and so on, it's not really a terribly easy way to kind of navigate the way through the systems. It's I've actually got something at the moment which is really interesting. A client of mine is in this space, and they're thinking about taking buying some new software to run their business, a specialist software package. And there's about 3 or 4 reasonable sized firms in the sector who provide that sort of software. So I've been looking for options to improve the software, which will reduce my clients' operating costs. So that's what I'm trying to do. The interesting thing with all these businesses, without exception, is I cannot get to talk to anybody about their service unless I sign up for a free demo of their software. Now, I find that quite staggering because, I mean, I'm an accountant. I'm not the technical specialist who would be using that software anyway. I can kind of imagine what it probably does, but in the nicest possible way, I don't really care what it does, because I'll get the technical specialist to take a view on that. What I'm trying to find out is, how much does it cost? When can I have it? You know, what sort of quality are you going to guarantee? What ROI are you going to sign up to? You know, do we have to manage this through an integrator? Do we deal it direct with you? You know, these are all the questions I want to know the answer to, none of which are going to be solved by a product demonstration.
Right. So don't waste your customers' time, and don't create obstacles to having them do business with you.
Exactly. So, you know, I've emailed these businesses, nothing, absolutely nothing from their, you know, from the contact pages. I've left my phone number. I had a web chat thing with one of them, which is one of those dreadful automated web chat things, which I hate with a passion.
You're talking with a robot.
Exactly. But at the end of it, I said, look, here's my number. Here's my email address. You know, if a human ever gets around to reading this, please contact me, because I'd like to look at buying your software. And I can't for the life of me get anyone to respond. So that's a sort of example where it's probably some software selling best practice class all these people have been on. Although if that's best practice, quite frankly, I think that term probably is under some severe question.
Right.
But, you know, people have been told this is how you sell software. It isn't actually. It's how you irritate the living daylights out of potential customers. Because, you know, you'd have to drag me over hot coals now to deal with any one of these organizations, because all they've done up to press is irritate me. And all I wanted was a simple answer to a question. How much is a license? That was really all I wanted. I don't want the 1 hour webinar. I don't want the product demo. I'd like somebody to respond to my emails. I would like someone to take action based on the automated web chat. But no, we're not going to do any of those because we're not even going to talk to you until you've done a product demo.
So they're during all of this time, they're not making the sale. So one thing related to best practices is data, and you have things to say about data. There's a great quote. The problem with metrics is that smart people try to game them and dumb people try to achieve them.
Yeah, it's you might think that's a little controversial, and perhaps it is, but I find that there really are those two camps where you'll have somebody who's going, oh, come what may, I need to make 47 calls a day or something, so they make 47 rubbish calls a day because that's what they've been told to do. So they're completely disconnected from what are we expecting out of this? Because actually what we're expecting out of this is not 47 calls. It's the 4 people who say, yes, I'm interested, tell me more. So 4 people you're after, it's not the 47. But, lots and lots of organizations, you'll get the sales leads through from the marketing team, or maybe you develop them yourselves, you do whatever. But people just pursue that. I've got to make those 47 things. And that's just not very smart, because if you talk to 47 people who are very unlikely to buy what you want, you're not going to make any sales, never mind the 4 that you're hoping to get. But then on the other side of it, I find, what people often do is they look at something like that and go, well, there's I've got to do 47 of these. What's the easiest way for me to tick a box, do my 47, and then I'm done? So they're trying to find ways around the system. And probably one of the best examples I can give you of that, which always amuses me, and I had a kind of sneaking admiration for him, even though I did have to fire him, but it was still really good. I used to run a large customer contact operation, like a sort of multimedia call center operation, and we had a guy there whose stats were excellent. Call centers are very heavily statistics driven. There's lots of information built into the systems, easy to get. And there's a guy there who we thought was absolutely the best guy that we had. Very nice guy, very pleasant guy to talk to. But one of our key metrics, as it is in many call centers, is call length. And this guy was always within his call length, always. He never went beyond it. And we used to sort of use him as an example to other people, say, look, your call was 6 or 7 minutes long, but actually, look, he can do them in less than 3 minutes. What's your problem? But purely by chance, we had a kind of random selection process where we'd listen to calls and, just to assess for quality and to help the senior management team kind of understand what was going on in the business and what real customers were raising. And what we discovered, the reason this guy was always within his target was every time the call got to about 2 minutes, 55 seconds, he put the phone down.
This is what's known as the tail wagging the dog, right? The metrics are the tail wagging the dog.
It's absolutely right. And it happened once and we thought that's a little odd, but maybe the line was broken or what have you. So we went and then we dug out more of his calls and we discovered this was happening actually really quite a lot. And clearly it was unacceptable for all sorts of reasons. We had to part company.
And it set the benchmark, as you said before. You were coaching other employees to say, why can't you? If he can do it, why can't you do it? Well, because he wasn't making authentic calls, he was gaming the system.
Exactly right. And he's a bright guy, so he worked out that was how he stayed out of trouble, and he got everybody to say he did a wonderful job, and you get pay increases and everything else in the back of it. So you've got to give him marks for the smarts, if not for the integrity.
Speaking of integrity, actually, seriously, this is kind of a recurring theme in your book. You talked one time about doing trial projects during employee interviews, but you said if you're going to do this, if you're going to have people actually do work, you should pay them. You also talked about with supplier negotiations. I think you used the phrase, a good supplier is worth their weight in gold. So it has to be a win-win. It has to be profitable from their end as well. And there was another article that you wrote that I read where you use the word moral compass. So I just kind of see this recurring theme about increasing your cash flow is within the context of business ethics. So maybe you could speak to that.
Yeah, it's something I feel quite strongly about. And slightly before I answer that, to give a slight little bit of context, I actually started off in life not as an accountant but as a lawyer. So my degree is actually in law, and then later on I became an accountant. So I do have that kind of, and it's why things like corporate governance and so on get me quite excitable, because it's a bit like constitutional law frameworks where, if you don't get that bit right, then all sorts of things can happen, and none of them usually are very good. So I do carry that bit of baggage around with me, and it does mean that sometimes I get a bit prissy about corporate governance, and people go, "Oh, calm down, don't get so excited about it." I go, "No, it's really important. It's really important." But part of the reason behind this is that, first of all, there's an element of, well, do unto others as you would have them do unto you, which is something that my grandmother and my mother sort of drove into me. But I think it's also just smart business. It's whether you believe that or not, it's smart. So if we look at suppliers, for example, a lot of businesses have problem with suppliers. Suppliers let them down. They don't do what they say they're going to do. They don't deliver on time. They cut corners with their quality. There's all that sort of stuff goes on because the suppliers are trying to game the system. You've beat them down in price, so they've now got to find a way of doing what they used to do 10% cheaper, and hopefully you're not going to notice the difference. That's the basic scenario there. But the difficulty with that, though, is that what that means is you're probably going to get a product that isn't as good as the one that you thought you were getting. Maybe not in very visible, obvious ways, but in one way or another, it's not going to be as good because you're not going to be able to justify that if you're the supplier. And what that then does, it means that when your business sells on the product, which is incorporated whatever it is you've bought from that supplier, that is also not going to be quite as good as it was before. And that's going to then lead to, in all probability, some degree of customer complaints, quality issues, the things we spoke about before, where actually that's going to come back and bite you. The trouble now is, somebody who maybe supplied you with a fitting or something that cost $5 that you've put into your system that cost $1,000. Well, now you've got your customer is now going to raise $1,000's worth of hell with you over a $5 fitting that you ground down from $5.50 or something because you were doing stuff to improve your margins. You thought actually it's completely backfired on you. You would be much better off taking that $5.50 initial cost and then working through with your customer to give them all the reasons why they shouldn't be paying you $1,000 for this. You should be paying 1,500 quid for it.
Sure. And if the attitude of
and that's
senior
probably
management,
a much better time.
If the attitude of senior management is to cut corners, then that probably gets sensed by employees and just trickles down, as that's the MO.
I think that's right, and I know a lot of organisations run at that because there's we've got to hit the numbers this quarter. We've got to report to the bank. We've got to report to the group CEO. Whatever those things may be, and they're all the drivers. So yes, at some level, that's right. I get that, and I do understand that. And there is a bit of a challenge to get you through that gap from kind of where you are to where you need to be. But it's a remarkably quick thing. It's not often one of those things where it's going to take you like 4 years to make the sorts of improvements you need to make. It might take you 2 or 3 months. Those 2 or 3 months might just dip across a quarter end or something. You might have to ride out a little bit of performance in one quarter to make sure you nail it the next quarter. So we're not talking about enormous amounts of time. But of course, this isn't for the chief executive of Coca-Cola or whatever. This is about someone who's probably running their own business or perhaps part of a family business or a more entrepreneurial setting. And actually, it's up to them if they want to go, well, if we don't make it in March, if we make it in April instead, I'm not too bothered. And that's one of the advantages of of owner-managed businesses, you can actually take that slightly longer-term view that maybe if you were Coca-Cola or Walmart or one of those organizations, maybe you wouldn't have quite so much freedom to do that.
Too
And it's
much
also why
outside pressure in a public company like that.
That's right. That's right. And it's always it's always rather amazed me that people say things. Oh well, I'd love to offer better customer service, but it takes too long to pay it back. And I'm thinking, well, what are you doing that it's taking you 6 years to see a benefit from improving your customer service? Because my experience is you'll get that in a couple of months. It's a kind of excuse to say, oh well, we're not even prepared to consider a different way of working, when actually you're almost talking yourself out of being successful because it's pretty quick. Or it might not be 2 months, it might be 3 months or 4 months, but it's not 6 years. And that's the opportunity I think a lot of people are missing.
So you were talking about improvements. Chapter 30 of your book talks about the biggest single contribution you made, and it talks about continuous improvement. Could you talk about that?
Sure. I used to run a manufacturing business in the printing industry, and we were printers, and we produced predominantly packaging, so the sort of boxes that you might get like breakfast cereal in or something like that. That was the sort of thing that we did. In actual fact, you'd be interested to know that Yorkshire Tea was in fact one of the people that we used to print the boxes for, Andrew. So
Sorry.
That's it.
Hey, there we go. This is Alastair's product right here. Okay.
Well, it was several years ago, and let me tell you, they're lovely, but they're hellishly difficult to print. But that's a different issue altogether.
Okay. We'll have to do a separate conversation about printing challenges. Okay.
Exactly. But part of the challenge there is to think about, we've got to make a manufacturing process work. Printing works by, you've got ink, you've got paper, you've got a printing plate. We were lithographic printers. You've got printing plates. That's how the process works. So you've got to respect the kind of mechanics of the process, but at the same time, you've also got to think about, well, how could we make this better than it is just now? How could we make this more efficient, more effective? And one of the key metrics was, when your presses are running, you're making products that you can sell. When your presses aren't running, by definition, you can't make anything anybody's going to buy because nobody pays for dead time. Of course, as every job comes along, we need to take the press down for a bit because we have to put on new plates. We might have to fill different ink in the reservoirs and things like that. We've got some fiddling around to do to make sure the job's printing right to the correct standard and so on. But that is a cost to us because we still pay all the salaries. We still pay for all the depreciation in the machines. We pay for the heat, the light, the rates, the rent, all that sort of thing. So our costs are running all the time, but our revenues are not, because the machine's not working. It's stopped while we get ready for another job. So one of the things we looked at was, what are the bits that happen in that process that we can minimize that as much as we possibly can? So, and it goes from really little things to really big things. So an example of a really little thing was the printer used to have to walk into our pre-press department to get the printing plates for his next job. What we did instead was we got the pre-press department to take the plates out and stack them next to the machine in the order that the job was going to be run. So the printer had to go 2 steps instead of, it probably took 5 or 10 minutes a job to walk there, to say hello to the pre-press guy, to make sure he had the right plates, to walk back again, to fit them, etc., etc. So we get 10 minutes down to probably 30 seconds. And if you do enough of that often enough, it's amazing how many more jobs you can fit in the course of a day. And we didn't change anything about the printing process because, the machine works that, you press some buttons on the front and it does things automatically. We didn't change anything about how we printed. We changed all the stuff round about it, which meant we spent more of the day printing. And
so
that
it sounds like it's the continuous improvement point is that it's not one gigantic one-off initiative. It's an ongoing process of lots of little things.
It is. I think the one key thing I would add though is it's the little things have got to be driven alongside the people working the machine. Or, obviously in a different environment, people in the office, or, whatever line of business you might be in. Because it's first of all, if you're sat in an office away from the shop floor, you would never know that was going on anyway.
Right.
And also, you're in the worst possible position to start issuing instructions to people on the shop floor to say, we need to take half an hour off the make ready time, so I want you to do X, Y, and Z, because you don't have to make the thing work practically. And the guys on the press are not committed to your solution because, well, they probably think you're an idiot, quite frankly. And they've certainly
What does this accountant know about printing?
Well, exactly. But if you work with them, and one of the things that I did was I helped them understand that we wanted the press to be running as much of the day as possible, because that was generating the revenue that paid their wages, that allowed us to make a profit to reinvest back in the business. And so, when you work with people and they understand that, and they have to believe you're sincere, that's the only other thing, because if you do all that and then you fire half your printers, then no one's
Right.
ever going to help you again.
Right. So staying in touch with the frontline staff is another theme of the book. There were a couple of things that I remember. One was your daily 5-minute meeting at the beginning of the day, and then another one was later in the day you would walk around and talk to everybody.
Definitely, and it's one of my fundamental principles is there are two people who can tell you everything that's wrong in your business. One is your frontline staff, and the other is your customers. If you want to know why your business isn't working, if you ask both of those, you'll have everything that you need. I'd love to say that the answer is an accountant comes along with a magic wand and sorts it out for you. I'd love to say that, but it's not true. But both those groups, they can tell you what's going on in the business, and they can tell you what's not working. And particularly, one of the things I used to do a lot was when I used to kind of walk around and talk to the guys around the factory and so on. It was trying to understand what has got in the way of them being able to do the very best they could have done today. What didn't happen that should have happened? What happened, it was okay, it just happened 10 minutes too late, or half an hour too late, or they were waiting while somebody did this other thing before they could come and help them with that, or all those sorts of things are things that got in the way. And within a lot of businesses, whether people recognize it or not, there are a lot of effort goes into kind of undoing or redoing things other people have already done or not done, or should have done but never got round to, or whatever in the business. And again, it's a case of, if you stop doing those things, if you just take them out, if you just connect the dots a bit better, because a lot of organizations, they run in hierarchies. So, I'm this department and I'm that department. And what we're trying to do in each department is to go, well, how can I be the most efficient finance person I can be, or the most efficient HR person I can be, or the most efficient printing person I can be. And actually, often to do that, you can do that as long as you're not too bothered about screwing everybody else up. I could run a much more efficient finance department if I was never concerned about paying any suppliers. It wouldn't work for very long, right. But I can be really efficient.
Right. So this sounds like taking basically, there may be things that the frontline worker doesn't really have the power, or doesn't feel like it's their place to suggest changes. But if you are in touch by meeting with them directly on a daily basis, then you're aware of these issues, and you can take these obstacles out of their way to make them more effective.
Exactly right. Although again, I think the important thing here is that might be where you start, but it can't be where you finish, because what you have to be able to do is you have to be able to empower the people in the front line to actually have those conversations themselves. And also for people, whoever they're talking to understand that actually what I'm hearing is something important. If somebody from the printing press comes to me to say, look, this thing that you did meant we had half an hour of downtime in the machine today. What can we do tomorrow to make sure that doesn't happen again? They need to, whoever it is they talk to, even if it's somebody quite senior in the organization, they need to go, just a minute, that's quite important. I should be concerned about this. I might be, the sales director or something like that, but I should be listening to what this guy from the printing press is telling me, because that's going to be affecting the business. And it only really works when actually I'm not involved. Because when you're the chief exec of a firm or whatever, or even the CFO, to be honest, because people tend to listen to CFOs. If I say, look, this is the way it's going to be, people go, oh yeah, okay, boss, that's fine, I'll go and do that. But that's not success. It might look a bit like it, but it isn't. Success is when the guys in the front line are doing it, and everybody else is seeing it as important as I would, and in fact, as the guys in the front line would, because most people on the front line, they want to do a good job. They want to do high quality work. They want to be appreciated for what they do. They want to be recognized as people who make a difference in their business. That's what people want in the front line.
And it just speaks to intrinsic motivation. Nobody wants to be a drone. Everybody wants to feel like they're doing something meaningful and quality work.
Exactly. Now, I mean, do 5% of people or 2% of people not do that? Yeah, of course they do. But 95%, 98% do, and they're the guys you want to work with,
Right.
because they will, if you support them, they will make your business a better business, and it will generate more profit. It will generate more cash. But it's a different way of running than most organizations would do, who are more used to that kind of hierarchical structure thing where the bits are not as well connected as they probably should be.
So one area where a lot of companies spend a lot of money is on marketing, branding, advertising, and sometimes there's not an immediate payback on these things. So I was curious to see what you had to say about the short-term and the long-term nature of marketing expenses.
Yeah, I think, as you know, I'm very much a supporter of marketing, which I think is often misunderstood and misinterpreted, because to answer your question, I have to kind of take it back a little bit to the value of an organization. The value of an organization nowadays is based largely on what an accountant would call intangible assets. So things like intellectual property, or the branding, or the customer satisfaction, or the customer repeat purchase propensity, or any of those metrics that you want to think about, they're the ones that really matter in the business. They determine your future cash flow, which, at least in theory, is how your business will be valued. But they're not things that you can kind of buy in a package from a shop, or you can manufacture in a lathe or something like that. It's not a scientific mechanical process. It's a very ethereal process. So you have to be working in those things. And for me, a bit like we're talking about quality earlier on in this conversation, marketing is exactly the same thing. If you get that right, and if you think about working in the longer term, then actually you can generate significant improvements in your results. A good example, I had a client not very long ago who I did some analyses for them with their customer base, and I discovered that a large part of their marketing expenditure was spent on attracting customers who were, by definition, going to be unprofitable customers for them. And so I was, now the marketing team, to be fair, were just going, well, we've been told to get more sales, so we're off to get more sales. So,
but the salespeople are usually incentivized on revenue, and they don't necessarily understand the margins.
Well, exactly. And also in a lot of organizations, people don't understand the margins at a granular enough level. So, they might get the gross, but they might not necessarily work it out in the way through. So basically, customers who are always trying to beat you down in price and who never pay you in time aren't anything like as profitable as you think they are, even if they've got a fairly attractive gross margin. And I find in most organizations that I go into, the customer they think is their most profitable customer almost never is. Because what they've got is, oh, well, we supply this to Coca-Cola, and that's brilliant, and that's lovely. And, oh, look, we're making a 50% margin. Coca-Cola are really giving you the runaround to deliver that because they recognize that you get some kudos associated with being a supplier. So they're going to get every penny out of you they possibly can. And you will probably willingly give it to them as well.
Well, and then you probably risk the dependency of you if they become 50% of your revenue, that
Absolutely.
you become very vulnerable.
Exactly. And of course, in a lot of large organizations, that's exactly what they want, because that's how they make sure that you keep behaving yourself and you keep doing what they want you to do. And sometimes you've got to be a bit, got to be well, first of all, a bit bold, but second of all, a bit dispassionate about this, because if you're looking at a situation where, yes, you might have a wonderful brand and what have you, and if you want to say as part of your own marketing that you deal with Coca-Cola and that's one of those names you put in your PowerPoint slides, just accept a big chunk of that's really marketing cost. It's nothing to do with you making any money out of dealing with them. You're almost just having
just the bragging rights.
Yeah, exactly. You're having the bragging rights. And as long as you're clear about that's what you're doing, then keep doing it. That's okay. But a lot of people run the business on the basis of this is how we do things. And actually, you might well be better off not dealing with Coca-Cola, because what you'll find is, because you can then run the rest of your business so much better, that it's a vastly more profitable organization with a lot less time and effort and hassle and aggravation. Because what you've done is you've attracted the right sort of customers for your business, whatever they may be. So that's the sort of dimension where I think working with colleagues in marketing and thinking about how we're going to sell this and who we're selling it to, and is that really going to generate as a cash flow? Because if you're dealing with, again, I don't know about in the US, but in the UK, if you're dealing with a major supermarket over here, you've got really long credit terms. You're supplying to Tesco or Sainsbury's or Asda, which is the kind of Walmart over here. You might have 90-day credit terms, 120-day credit terms. Well, if you're only making 2 or 3% margin, and then you're having to wait 90 or 120 days for your money, you're probably not making any money really, whether you think you are or not.
With the cost of capital.
Exactly. So it's kind of thinking those things through. And for me, the whole purpose of marketing and branding and all those other types of expenses that we spoke about is it should be about bringing in more of the sort of people that you really want to be dealing with. It's not just about making a sale for the sake of making a sale. It's not about bragging rights. Although if you want to do that, that's fine. Just be clear that's what you're doing. But the bulk of your activity should be generated at where do we make the most profit from, or where can we engineer a greater profit from? Maybe the way we do it now it is not, but it could become that. And then how do we try and focus on making sure that's what attracts us? And I know there's a lot of talk about social media and digital marketing, all that sort of thing. I think sometimes people get a little bit wrapped up in the technique and they forget actually the principle behind it. So whether you're doing it on Facebook or Twitter or LinkedIn, or whether you're doing it in inserts in the local newspaper or wherever you're doing it, if you don't know what customers you want more of, it's very hard to get your marketing right, because you're probably not approaching them in the right way. You're not approaching the right publications. You're probably not using the right language to talk to them. Like I was saying earlier on, the guys selling the software, they wanted to talk to the specialist fee earners in those fields. They weren't set up to talk to an accountant or a finance director, even though I would have thought that they might well be quite commonly the sort of person who would call a software company to say, we know you're selling this, how much is it? It's a fairly basic question. But from their marketing point of view, they'd never even conceived of the possibility that might happen, and therefore missed out on an opportunity.
So I know I said in the beginning that this book was written and very understandable for somebody without an accounting background, and it doesn't dive into the technicalities of income statements and balance sheets. But I did want to ask a question, because we had spoken about, basically the book is more about the perspective of managerial accounting, how to run your business based on the financial perspective, financial information informing your decisions. So within the an income statement, you break down your sources of revenues and then all of your expenses. So do you find that having an increased amount of granularity in the expenses helps to discover more actionable information, as opposed to just rolling everything up into catch-all categories?
Yeah, it's an interesting question. I think it can do, but sometimes it obscures more than it illuminates. So I think I would take it back a stage further and say that before you get to that sort of level, you actually need to think about what is the information you're going to want out of the back end of this process, and where are your priorities. So, irrespective of whether or not I would think this was a good idea, but many organizations, particularly if they're VC funded, it's all about growing the top line. That's their priority. So if the set of information that you would probably need, if that was your primary focus, would be a very different from a bulk chemical manufacturer who was, dealing with a by and large steady demand of a by and large well understood product that they'd made for many, many years. So I think it's so for those, I think the information requirements are quite different. And this is where to get your cash flow right, you actually have to start right back at the beginning with, well, what's your strategy? What are your objectives? And then all the things that you're doing should be around how do you support achieving that objective? So if it's sales growth, if it's, squeezing the last 0.07% efficiency out of your chemical manufacturing process, whatever those things are, kind of set the template for what you need to do. And then that sets the information needs from a management accounting perspective. Because again, when I'm working with clients, what I'm very often doing is I'm trying to present their financial information differently, because that makes it easier for them to understand what their key issues are. And I say this a lot to clients, so if any of them see this, they'll hear this quite a lot. But one of my sort of mantras is, if I'm doing my job really well, then it should be obvious what decisions you need to take in the business. I should be presenting you with information in such a way that you don't spend hours and hours and hours going, I wonder what he means by that. Oh, well, it could mean this, it could mean that. Maybe it's this other thing. I'm doing my job well if I'm presenting you information, you go, right, I know exactly what that is. I know exactly what that problem is. And I know what we need to go off and do and fix it. That for me is what you're trying to achieve. Whether that's your, year-on-year top-line growth, or your 0.07% out your manufacturing process, all that information should be arranged in such a way to focus in on those key metrics, because they're the things that are going to make a difference to your business.
This may be too big of a question to answer, but I'll ask it anyway. It may take forever. So the cash flow problems would be different, I would imagine, from depending on the phase of whether it's a startup company or a growth company or a mature company. Would you like to speak to that question?
Yeah, I think the main challenge is, if you're running an established company, whether it's doing well or whether it isn't, it already has some cash flow. So you've actually got something you can work with. It may not be in an ideal setting. There may be all sorts of things you want to do with the business, but you've got some customers, cash is coming through, there's some financial velocity going on in there, you've got some options. The harder bit with a startup, and I suppose it's, I forget which one it is, one of Newton's laws anyway, about, it's a lot easier to keep something going that's already moving than it is to get something moving when it hasn't started yet. And that for me really is the cash flow challenge for more businesses, more at the startup end of the spectrum, because what they've got a different issue, because their primary concern is around cash burn. So how quickly do we go through the cash we've got, or can reasonably expect to have? We may not have it now, but we might, maybe we're going to be able to draw down a bank loan in 6 months' time, so we can factor that in. But, are we going to live long enough to get to the point where the revenues coming in bring in enough cash to cover our costs so we can keep operating? And that primarily is the key metric in those smaller startup, more entrepreneurial businesses. And it's also a lot harder to predict, because if you run a business, whether you've run it or not, if business has been going for 30 years and it's got cash flow and it's got customers and it's got things like that, it is inherently much more predictable. Because if people bought, 47 tons of soap powder last month, they'll probably buy about 47 tons of soap powder this month. So again, it's an easier job. I'm not saying it's easy to run that business, but trying to see into the future becomes a lot easier. If you're starting out a new app today to rival TikTok or something, well, who knows? Are you going to get any customers? Are they going to pay you? Are they going to convert from, a free tier to a premium paid tier? Are they going to be downloading enough from the Apple iTunes to be able to move up the rankings so that more people download it? There's so many more variables in there. But fundamentally, it's about saying, well, look, we've got, let's say we've got 9 months of cash and then we run out. So as we're going along, what does our trajectory need to be? And are we delivering in line with that trajectory so that we can reasonably expect to get there on time? So that's where the differences tend to come. So it's creating cash flow is problem number one in your startup end of the operation. And actually maintaining and optimizing cash flow is the problem with more established businesses. And then everything else tends to follow within those two different sets of parameters. But you're absolutely right, Andrew. They are quite different dynamics, and you would need to be looking at different sorts of things by and large.
Sure, and in a growth strategy, I guess I was thinking that you could think you're being very successful because you have an enormous growth rate, but it could create some cash flow problems for you to keep up with that.
Well, and that is also true. That's why, one of the key things for me is what I call the business model. Other people use different terms for it. But you actually have to map out, where are the cash flows taking place in this business? Because in a lot of organizations, not all of them, but a lot of organizations, you very often are paying out before you get cash in. So even in a simple service business, probably you're paying a salary today for someone's work that you will bill at the end of the month, and maybe 30 days later, someone's going to pay you. So you're out of pocket for 6 weeks on that person's salary before you're going to get paid for the work they do today. But of course, in a manufacturing environment or something that's not just about people service by itself, very often people have to buy, let's say, a truckload of material or a shipload or an aeroplane load or some much larger unit that they can then work off over a period of time. So their cash flow is actually significantly negative and only becomes positive after really quite a long time of being out of pocket. This goes back to one of the questions you asked earlier on about margins. So in that sort of organization, people will go, oh, our margins are very good. We don't understand why we don't have any cash. Well, I know why you don't have any cash. It's because you were to buy 40 tons of material 3 months ago and you still got 20 tons of it in your warehouse. That's why you don't have any cash. All your cash is in your warehouse. And that's a good example. We're talking about a moment ago about financial information. That's a good example of the sort of thing that you have to try and reflect within the financial information package every month to show people that's where you tied up your cash. Very often I work with clients, for example, one of the key metrics in a lot of businesses, nearly every business, is things like we call them debtor days. I think receivable days. I think you call them in the States. People say, oh, I've got 73 days receivables, or 42 days, or some other number. And I was thinking, well, that's very interesting, but what is that? How much cash does that mean? So if you sell on 30-day terms and you've got 77 days of receivables,
right.
That tells me that you've probably got 47 days worth of cash there that should be in your pocket, not in somebody else's. And actually, that might be worth $1 million. So you've left $1 million in somebody else's pocket. That's not going to do your cash flow any good whatsoever. And it's, so do you want to keep dealing with that customer's kind of question number one? Or maybe you need to improve your internal credit control processes. Or maybe it's because you've got quality issues that the customers are arguing about refunds, so they are not paying you until you've sorted out whatever the quality issue was. But whatever it is, if you've got 30-day terms and 77 days receivables, something is far wrong in that business. And the quicker you get to grips with it, the quicker you get that £1 million back into your account, not into your customers' accounts. And it should really be in your business account, because terms are 30 days.
Wow, I think we've really covered a lot in an hour, Alastair. Thank you so much.
Hey, my pleasure.
And so the book again is Cash Flow Surge, and you can see a review of it at thekeypoint.org, and there's a link to Amazon there. And any parting words?
Well, just thank you for the interesting conversation, Andrew. And it's been a fun process pulling a book together. If you'd asked me 10 years ago, I'd never have thought I would probably have written a book, but really glad I did. And I'm really appreciative of the fact that you've been kind enough to have a read through it. You've made some lovely comments, and you've also given me the opportunity to chat with you today, which I really appreciate. So thank you very much.
All right, thank you as well.